Welcome to Market Week in Review for the week ending September 24th, 2021. I'm Sophie Untitled, and I'm joined today by my colleague Shay Shatria, Director of Investment Strategies at Russell Investments. Hello, Shay. It's wonderful to see you.
Great to see you, Sophie. How are you?
Very good, thank you. It has been a busy week, and I'm hoping that you can help us recap, refocus, and retune. Where do we need to be looking? What do we need to be paying attention to in this news-filled week that had with it Federal Reserve and Bank of England and Bank of Japan meetings? So a lot of central bank activity and talk happening. We also had an issue with Evergrande out in China that I'd love to get your views on and understanding of. And then maybe coming back, if we have time, coming back to the US and potential government shutdown looming. Those are sort of the things that have crystallized for me this week that I was hoping we could pick your brain on. Sound good?
Sounds great.
Terrific. Well, maybe starting with central banks. Central banks around the world had a busy week this week. What sort of rose to the top of your attention list, and where would you suggest that investors focus, especially in sort of the months to come?
Yeah, it's well, to your point, Sophie, it's been a very interesting week. If you just kind of take a quick snapshot of the market action, which was generally risk-off tone earlier in the week, where equities were down and bonds were rallying, but then the markets have calmed down a bit and have been recovering since then. And I think some of the things that we'll be discussing, as you laid out, clearly contributed to the market action this week. So starting with the central banks, obviously the most consequential always is the Federal Reserve. So maybe that's where we can start. And the Fed made no changes to its policy rate or its QE program. However, there were things that we were keeping an eye on and the lookout for. Three things in particular. One was the advance notice for tapering. The second was clues around the pace of tapering. And then finally, what did their dot plots reveal? So if we kind of quickly go through each one of those individually, as it relates to the advance notice, we were expecting the Fed to provide some form of an advance notice that tapering would commence soon, and we did get that. The Fed indicated that if progress continues as expected, a moderation in the pace of asset purchases may soon be warranted. We believe, given that statement, we believe that a formal announcement is probably forthcoming at the November meeting, and then the tapering to potentially commence starting in December. So that was broadly in line with our view as well as the consensus for the most part. So no real surprises there. Where it does get a little bit more interesting is actually the tapering pace, which is the other thing we wanted to keep an eye on. And in the press conference, what was interesting was Chairman Powell indicated that the tapering process could conclude around the middle of next year once they get going. So that suggests that tapering could complete in about 6 to 7 months, which is actually a few months quicker than what we had expected. So this was a bit of a hawkish surprise from our perspective, and it does have implications on the timing of the first rate hike. And to get a little bit more clues around that, I think the dot plots are clearly interesting because, if we take one, obviously, which is now a quicker tapering pace that the Fed is suggesting, and then you couple that with the dot plots, which indicated that 9 Fed officials voted for a rate hike as early as 2022. So this suggests that the timeline for liftoff could be sooner than our baseline, which we had penciled in for 2023. So we still believe 2023 is most appropriate, but 2022 now cannot be ruled out if certain conditions are met. One would be full employment, and let's assume that the labor market remains strong and continues to recover over the next 12 months, and that should be pretty much checked off. The other is inflation. Now, we know that the Fed's inflation objective has already been achieved, and they've indicated as such. However, from our view, we expect inflation to moderate towards 2% over the next 12 months. However, if inflation is a bit more sticky than that, right? So inflation is pretty high at above 5% right now, and if it stays elevated, come 12 months from now, and in addition to that, we have full employment, then a rate hike late in 2022 can't be ruled out. So inflation is something that we're clearly keeping a very close eye on, but The other thing that was revealing about the dot plots is irrespective of the timing of liftoff, they are suggesting that the pace of rate hikes will be gradual once the Fed actually gets going. So that's the Fed, and really quickly then on the Bank of England and the Bank of Japan. The Bank of England didn't make any changes to their policy rate or QE. But even there was a bit of a hawkish surprise, perhaps, where many in the committee are getting a little bit more concerned about the inflation outlook and are potentially suggesting that the rate hikes could happen a little bit sooner, perhaps as early as the first quarter of 2022. So that those developments there will be something that we'll be keeping an eye on. And shifting gears with the Bank of Japan, they're a little bit different situation there, where they again made no changes to their policy and are pretty much committed to ultra easy monetary policy. For the foreseeable future. And one thing we know about the BOJ is that they'll likely be the laggard as far as tightening policy. So the BOJ is probably on hold for the foreseeable future, and we'll wait for their other central bank counterparts to get going.
Oh, thank you so much. That was a really thorough overview, and I guess it's a little bit of a give and take. On the one hand, it always is a little bit unnerving and rattling to markets when there are potential changes in central bank policy. At the same time, sometimes central bank policy, especially the types of changes that we're currently contemplating, are also a reflection of the economy and unemployment and stuff improving. So it's a little bit of okay, we want things to get better, but then the change can sometimes make markets and investors a little bit nervous. So thank you for that summary. Moving our attention a little bit, we just talked about the US, we talked about England and the UK, and we talked about Japan. I'm curious, let's cast a light briefly on China and the situation there with Evergrande that has made a lot of headlines this week and is sort of being characterized, depending on who is, sort of analyzing the situation, as a potential Lehman moment for China. Can you help us understand what is happening there and what are you focusing on?
Yeah, there were clearly a lot that the markets had to chew on this week, but the jitters earlier in the week were at least partly attributable to the story related to Evergrande. Sophie, as you kind of laid out, just to quickly recap, Evergrande is China's second largest property developer that has run into financial difficulties and is now struggling to meet its many debt obligations. So what happened this week was that the company missed a couple of interest payments that were due on Monday, but then later in the week managed to work out an agreement with its creditor for a payment due. But now, what's interesting is, as of this recording, there's yet another payment due that we're still waiting for information on, and that we haven't really heard on. So I guess it's sort of to be continued there. But nonetheless, the tension related to Evergrande contributed to the narrative in the markets that, to your point, Sophie, this could be China's Lehman moment. And although the downside growth risks can materialize due to the importance that the property sector has in China, we believe that global contagion risks are minimal at this point. Now, an indicator that we're monitoring for this are Chinese high yield credit spreads versus, and how they compare relative to global high yield counterparts, as well as relative to Chinese investment grade credit itself. So, what we can tell so far is that high yield spreads in China, they've clearly risen and have actually risen to levels that are comparable to the levels that it reached during the pandemic. But we really haven't seen a significant spillover into Chinese investment grade credit, and even more importantly, much of an effect towards global high yield credit. So this suggests to us that contagion risk, which is probably what the markets were most worried about earlier in the week, um, haven't really materialized within China or globally. So that's clearly a positive. And moreover, we believe that Chinese policymakers could could step in or step up, I should say. They're easing their policy easing down the line if risks were to significantly escalate. And there were some positive signs there, as the PBOC did inject cash into the financial system this week to ensure adequate liquidity. So, overall, the Evergrande saga is far from complete. There are actually several payments that are still going to be coming due over the next several weeks. But I think what's also important to note is that there is a 30-day grace period. So a missed payment doesn't automatically mean default. Obviously, this is a story that we will be monitoring very closely. But for the time being, based on some of the indicators that we're looking at, we don't really see a systemic risk unfolding.
Terrific. Well, and I'm sure that gives the markets at least some reassurance that, yes, it might be a Lehman moment, but hopefully not truly like a Lehman moment with a whole bunch of contagion. Staying with the thread of potential sagas and missed payments and, sort of potential defaults on things, the debt ceiling in the U.S. and potential government shutdown. Where is that at, and what do we need to watch out for in the coming weeks?
Yeah, so
Dun, dun, dun.
exactly, perfect. The drama continues. But what's interesting is that we've seen this movie before, as it relates to the government shutdown. And I think it's easy to forget, but the US government actually shut down from December 22nd, 2018 to January 25th, 2019. So that wasn't that long ago. And that was actually was the most prolonged shutdown in US history. But what's interesting is that during that time frame, the equity markets were actually up around 10% over that period. So a government shutdown is clearly headline grabbing, but doesn't have to be problematic for the markets. Now, that said, more important for the markets is resolving the debt ceiling impasse between the Republicans and the Democrats. As we know, Treasury Secretary Janet Yellen has indicated that the Treasury would run out of money at some point in October and therefore risk defaulting on the nation's debt. Now, we struggle to get to a place where the US policymakers would knowingly allow a default. And House Speaker Nancy Pelosi did indicate that they're working on some type of a resolution. Clearly, there's a lot of political posturing taking place in the background and behind the scenes, but we do believe that the debt ceiling issue will ultimately be resolved. But this story is ongoing, and it's, I guess, to be continued at this point, and we'll have to kind of wait and see how the drama unfolds in Washington over the coming week.
Excellent. Well, drama in Washington, we are not new to that. And thankfully, although we are out of time for today, Shay, thankfully we will be back again next week. So thank you, Shay, for all of your insights and for helping us clarify this busy news-filled week. And thank you for joining us.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.